Target is down around 7% after reporting its earnings just before the market opened, but we do in fact see one hold rating from Seeking Alpha with a buy from Wall Street and a strong buy from Quant. So why is this company crashing? Why is it also down 4% over the last 12 months? We're going to take a look at their earnings today, understand the reasons behind this. We also want to take a look at the overall company, looking at both their top line revenue growth as well as their bottom line net income year on year. We'll also do a quick look at the health of this company, their total cash versus their total debt, and also something that is important, they are now paying a yield over 3%, so how safe is their dividend? We'll look at the underlying metrics with this as well, their free cash flows, their debt levels, and we also look at both insiders, a lot of selling that we will take a quick note on, as well as institutions, whether they are buying more or selling more quarter on quarter. And as always, we will run them through now with the updated numbers from this latest quarter into the valuation model, getting to both our intrinsic value, our acceptable buy price given that investor margin of safety, and look towards Wall Street to see what they're forecasting in terms of upside for this company. Very quickly then, before we do take a look at their earnings, let's just remind ourselves of the historical performance. Now, they are currently trading in the midpoint of the 52-week range. As we saw earlier, their yield, in fact, updated is over 3%, and their forward P sits around 16, which is significantly lower than the S&P, around 22. Now, yes, over the last 12 months, down 4.5%. If you have been a long-term shareholder, well, you would be up 156%. Bear in mind, if you do reinvest those dividends, you would be up slightly higher. And we do see all-time highs sitting around the $260 mark, and they are right now some way away off that at the $145 mark. So in terms of their earnings, well, the headlines does read that they did have an earnings miss, sales falling as well, which they do discuss in terms of consumers who have been buying fewer groceries as well as home goods. So let's take a look at the actual numbers, see what are the reasons for it. But one of the key points that we do want to draw out, which is also affecting the wider economy, what they essentially are saying is that consumers are buying fewer everyday goods like groceries, paper towels, and discretionary goods, which have really impacted their top line, as well as a reduction in foot traffic into their stores. Now, when we take a look at the actual numbers, well, it was a very small earnings miss, 203 versus 206 from what market was expecting. In terms of their revenue, though, it was a very marginal beat. 24.53 versus 24.52, the expectation from the market. Now, in terms of their forward guidance, they haven't changed this. They have just reaffirmed it, essentially saying flat to 2% with earnings per share to be around 860 to 960. And in terms of their net income, well, we can see it has fallen for the period by around 1% to 942 million. We can see from the same quarter last year, 950 million. So very, very small in terms of the movement. And one thing that we have noticed is the fact that with inflation, as we can see here, cooling, the consumer price index is still fairly high, up 3.4%. And what we typically do like to see, as well as the bank, they want to see around 2%. Now, in terms of how this affected their numbers, let's take a look at their historical performance. And as always, we do want to see a minimum of 3 to 7% growth year on year. 72.6 billion reported in January 2015, around 107 billion as we can see in that latest annual report, February 2024. So it has increased, we can see here, around 50% over the longer term. But what we do note, it is slightly inconsistent. Whilst it does increase, there are some years where in fact we do see a decrease. Overall though, moving in the right direction. How does the bottom line look? Well, in fact, they made a loss in 2015, 1.6 billion. But we do note a net income of 4.1 billion in 2024. And when we do look at it on a graphical basis, again, a lot of inconsistency year on year. In fact, the highs of January 2022 have not yet been beaten, as we can see a massive reduction into 2023 and a small increase into 2024. Something just to consider as we do move along in today's episode. In terms of the health of the company, well, cash 2.2 billion 10 years ago. Latest quarterly report, in fact, nearly double, 3.8 billion. We can see the cash position itself is very inconsistent. January 2021, we do see a high. Overall, though, this doesn't really mean anything in isolation, but what we do like to do, compare it to their total debt numerically and directionally, and we can see it has increased 12.7 billion in 2015, just under 20 billion in the latest report. So essentially 80% increase to their total debt, and we can see the trend over the longer term has been increasing And as always, this will be important, not just the overall health of the company, but also when we do discuss that dividend safety. Now, in terms of their earnings, how have they performed? Well, when we do look over the last 4 quarters, their track record is very good. They have beaten every single quarter, which is a good sign, 100%. Forward looking though, what we do note, single digit increases year on year, and then double digit, and then we see high single digit with a decrease. So very mixed outlook for the next 4 quarters, just something to bear in mind. And in terms of their earnings per share estimate for January 25, so the next year, that is essentially giving a forward P of 16.53, with the anticipated forward P of January 26 around 14.8. Now again, it does depend on what sort of metrics you do look when you are looking at adding companies to your portfolio, but again, the data is here for you to incorporate that into your own investment thesis. In terms of the valuation grade, so the first one that we are looking at, a B-. Now what we will take a look at is that P on a non-GAAP basis forward looking, 16.53, so it is at a discount to the sector, which is around 18. So as we can see here, you are getting an 8% discount to the median of the sector. If there are other metrics you do want to see, you can see here, one that we can point out, price to free cash flow on a forward-looking basis, 9.88, a lot lower than the 12.3 of their competitors, in fact 20% discount. And there are other ones here, lots of different valuation metrics that you can use. Overall though, in summary, as a whole, Target do get a B-. In terms of looking at their growth grade, well overall we get a C+. Few things to note, year on year, negative 1.6%, sector median, even though it is single digit, it is still positive. Forward looking, very marginal growth anticipated, 0.63%, sector around 4%. And we can see one thing that it is quite nice, forward looking, they're anticipating 13.53% increases year on year to that earnings per share, with the sector around 8.28. So overall in this category they do get a C+, but some of the things that we can like to see do look fairly decent. The only thing that we do want to see is that top line grow, which they have been struggling with historically and forward looking as it seems. We then move on to the profitability. Well, they get an A+. Few things that we want to point out, which is a little bit surprising. Gross margin 27.6%, that is lower than the sector median by 22%. Bottom line as well, not that great, 3.85, when the sector as a whole is getting 22% better at just under 5%. However, when we do take a look at other metrics like the cash from operations, significantly better, 8.6 billion with 858 million from the others. Overall, so mixed ratings from the analysts, Seeking Alpha, Hold, Wall Street Buy, Strong Buy from Quant, B- on the valuation, C+ on the growth, and A+ on the profitability. Now to wrap this section up, we will just take a quick look at how they've performed historically against others in the consumer staples. We have Walmart in the Mexico, we have Dollar General, we have Dollar Tree, Carrefour, as well as BJ's Wholesale Club Holdings. Now, over the last year, including dividends reinvested, we do see Target, in fact, one of the best performing in the top 3, and they are down 1%. So it does say a lot about this industry as a whole. They haven't performed that well in the more recent period. When we do expand it over the last 5 years, though, by quite some way, Target is very strong. We do see them up 130%, the second best. When we expand it over the last 10 years, we can see, in fact, they are right up there as one of the best, in line with BJ's Wholesale Holdings at around 240%. Do remember though, just because they have performed this well over the last 10 years, they could be in for a very poor next 10 years, or they could perform a lot better. This doesn't really mean much forward looking, just something we do incorporate. In terms of insider ownership, well, 0.23% with 5 instances of insider selling. This is over the last 12 months, totaling just under 16 million. Lightest quarter, well, nothing to note there. Q1, however, 8.82 million worth of sales. When we take a look at the date as well as who these individuals are, we can see the more recent one in March. In fact, quite a few noted in March. We do see the largest being Brian, an insider, 45,000 shares for just over 7.5 million. We also see some other insiders selling, totaling just over 1 million in combination. So a lot of insider selling in this year. Whether or not you do believe that is a bearish signal, just something to note here. When we do take a look, however, at the institutions, quite a high ownership percentage, just under 80%, 5 billion worth of sales over the last 12 months, with more buying, 7.52 to be exact, over the same time period. And we also note in the more recent quarter, institutions have been buying more as well as the previous 2 quarters. So it is one that they have been adding to the portfolio as well as over the longer term. However, we see a different story when we did look at the insiders who were in fact selling a lot more. In fact, there were no buys over the last 12 months. Now, one thing before we look at dividend safety, we have just released our latest latest free weekly article running through super investors, their buys and sells for a quick recap. If you want access to this or any others, in fact, we do run through undervalued dividend stocks. We even go through an article on all the websites and resources we use so you can copy and follow along. Any of this, instant access, all completely free by clicking on the pinned comment below. So let's move into the dividend safety. Now, they get a score of 80. It does look to be safe. As we said, now a yield of just over 3%. Market cap 72.1 billion. It is a large cap company. Now, their dividend safety was just reaffirmed 2 months ago, indicating that a dividend cut for Target does look to be unlikely. Now, in terms of the last recession, they did in fact increase the dividend during the 07-09 Great Recession. They had pretty much flat recession sales, which was above the average of the S&P, coming in at -12, and they also marginally trailed the S&P, -61, with the S&P coming in -55. Very, very poor increase to their dividend last June at 1.9%, so we are anticipating an increase over the next few weeks. Given that, in fact, the last 5 years as well as the last 20 years, they have been increasing it double digits. However, given their latest earnings, I would expect a very mediocre increase to that dividend this year. In terms of number of years, while they are in fact a dividend king, they have been increasing those dividends for 50 years or more. So when we move on to dividend yield theory, now this does state a company is undervalued when the current yield sits above the 5-year average. One signal of undervaluation here, another one with the forward P being below the 5-year average. Just bear in mind that we don't look at any of these models in isolation, and we'll conclude shortly. Consumer staples sector P as well, 18.7. It is above target now, so again, a third undervaluation signal. In terms of free cash flow, well, we do focus on this. If you do want to be industry specific, below 40%, what we do know, they have been pretty low consistently over the longer term. Free cash flow was negative, hence why the negative percentage in 2023. 53% in 2024, 51% in 2025 expected. No red flag indicators, and it does look healthy. In terms of the free cash flow per share, we do want to see this increase over the longer term. It has pretty much doubled over the last 10 years, but a lot of inconsistency year on year. It is expected to be fairly flat into 2025. Then we move on to the sales growth percentage wise. Now, do remember they are forward looking, expecting very minimal, if any, growth into 2025, and we can see over the longer term, while we do want 3 to 7%, it has been very, very inconsistent. Just factor that in, but it isn't necessarily a bad thing. Understand the type of companies, the industries they're in, and just have realistic forward-looking expectations. Shares outstanding, well, a very nice positive of Target. They do return excess cash to investors through those share buybacks that we can clearly see, so that is a big bonus. And total sales, just another format from what we did analyze not too long ago in the episode. Now, in terms of ROIC, personally, I want to see 10% or more to give me faith that management are able to effectively allocate their capital. They've done that pretty much every single year. The more recent year, pretty much bang on at 17%. So that is looking healthy and does make it attractive to those investors that are looking to add. Operating margin, we want it above 10% for consumer retailers. Very inconsistent, but it has consistently been below this number, so not a massive red flag indicator. We just hope that they are able to continue to increase both their revenue and their margins forward looking. In terms of the free cash flow margin, a very similar story. They haven't really been able to consistently keep this up year on year. More recent year at 4% though, looking a lot better than the previous year of -1%. Finally, we get on to an important metric that correlates to both dividend safety and balance sheet strength. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Remember, number of years to pay off all debt net of cash on hand. Below 3 is what we want to see for this industry. 1.75 looking healthy in 2024, there or thereabouts in 2025, so no red flag indicators. Dividend does look healthy, as well as the balance sheet does look secure based on this information for now. Let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Let's get into the first model, Graham's valuation, the ticker symbol, earnings per share, growth rate forward looking, corporate bond yield for AAAs, and we can in fact see an undervaluation signal 162 versus the 144. Just remember, we're not looking at any one of these models in isolation. We then move on to the multiples valuation model, a couple of companies that we analyzed earlier in a similar sector and size. Their average P multiplied by the EPS of target expected into the next year, and we do anticipate an undervaluation signal based on the market value of 144. We then move on to the dividend discount model. As we can see, over the longer term, they have had some very nice increases, although they have also had some media increases, notably the more recent year. Average 12%. Forward looking, we have gone lower significantly than the average, although higher than the previous year. 5.75. This does give an intrinsic value showing some severe undervaluation, 206.80 on the DDM model. We then move on to the DCF model, the free cash flow year on year. Average growth rate looking very skewed. We did see it in fact go from negative to massively positive in 2024. Forward looking 8%, very reasonable, in fact fairly conservative. With a discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and as we can see here, a fourth and final undervaluation signal. Now the intrinsic value, today's episode, average of these four models, coming to today 194.81. Just remember, you can also grab a copy of this model to run your own numbers through to get your own intrinsic value as well as your acceptable buy price, whether it's for target or those on your watch list or even in your portfolio. Now remember, we do execute on a 10% margin of safety if it meets our 3 golden criteria: a wide moat, strong financial metrics, good forward-looking data. If you agree for target, then it would be a buy up to 175, and then typically we go until we see what MOS level we are playing with in today's episode, and for target it does sit at a 25% level. Now, depending on what type of investor you are, you could be looking for a lot higher given the news of their earnings, given the fact that they are anticipating footfall to continue to decline. But as always, do your own due diligence. This is the information that we have run through on the estimates and judgments in today's episode. Forward looking though, analysts do see some nice upside, $187, 30% implied upside over the next year. But as always, let us know your thoughts. Is target one you're looking to buy on this drop, buy the dip? Is it one maybe on your watch list to see after a few days whether it falls even further? Or maybe for whatever reason, it isn't one you're buying. You may in fact prefer Walmart, you may prefer Costco. Let us know below. And if you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And we'll see you all on the next one.